Good morning, students. Today we are going to be looking at part 2 of the financial statement analysis on Bartlett financial statements. This will include the liquidity and the debt ratios. Okay, let me take you to Wolf Den. And we want to look at your Wolf Den page. Test 2 material. You need to pull up your PowerPoint slides for part 2, and I have those pulled up already. So chapter 3, part 2 PowerPoints. You need your ratio sheet. Let's take a look at that. If you haven't already pulled it up and done the first two, you need 2 copies of this. We'll be starting down at the bottom on the third problem, the inventory turnover. I'll do a quick review on the current ratio if you missed that, but you need to go back and look at the previous video that was sent out 2 days ago. Okay. You also need your Bartlett financial statements for today's class. Okay. This is going to be the income statement. And if you scroll on through, the balance sheet. So income statement and your balance sheet. If you don't know the difference, you do need to do a quick review. Remember your balance sheet equation: assets equal liabilities plus owner's equity. And then on your income statement, you have your revenues minus your expenses equal your net income. And all of the accounts that go into that we studied in Accounting 210. Now for homework, you will need your Apple financial statements. We'll take a look. You should have already done your current asset, your current ratio, and your quick ratio. Hang on to that. I'll add to that today, but this is the Apple statements, and I want you to be working with the 2013 column, not the other two, but the 2013, and whatever ratios we do in class, you need to repeat those and do those for homework. We'll conclude with all of those ratios on Friday, and you'll be submitting the entire sheet. So make you 2 copies of the ratio sheet that I pulled up a moment ago. Okay, this sheet. For today's class, you will also need the benchmark to do some comparisons. I have mine pulled up, but you need to pull up a copy just so you know what it is. These are numbers that you compare ratios to. Ratios are 2 numbers from a group of financial statements, a numerator and a denominator. Sometimes you get a percentage. Sometimes they're expressed in days or times. I'll show you some of that. But then you have to compare it. You can compare it to other ratios within the industry. We have 4 industries represented. This particular financial statement we're looking at is Bartlett, and they do metal fasteners. They're not exactly in the computer industry. Perhaps building materials is more suitable for them. However, Apple would be in the computer industry. So you can compare to other companies, Dell, Hewlett-Packard for Apple, or you can compare to the industry ratio as a whole, which is an average of top companies in that industry, to give an overall average of how the ratio should appear. And accountants use this to make analysis of how the companies are doing. Okay, so benchmarks, we want to take a look at that. Okay, let's get back to your ratio page and what we've already done. I'm going to move this down and also pull up my financials and my PowerPoints. Okay. Now, I told you the other day we're not quite ready to do this top part, so you don't have to look at that right now. We'll just kind of put a little X over it for the current time. We're not going to use that right now. What we did in class for Monday's class was to do the current ratio and the quick ratio. Now, there are 5 categories. If you go back to the PowerPoint, I told you in the very first slide, let me just flip over here, liquidity, activity, debt, profitability, and market ratios. 5 categories. You need to know these. You need to know what they represent. So the information in red is very important. So study up on those, learn those for the test. Let's take a look at your ratio page and group the ones we have into these 5 categories. Now the two we have already done, liquidity, represents how quickly we can convert our assets into information that can be used, or money, cash, that can be used to pay off current liabilities. So it's a measure of how quickly we can convert our current assets into cash. Okay. Now in the first one includes your current assets total. And if you come over here and look at your balance sheet, let's pull your balance sheet over here. Notice we have current assets up at the top. Those are your most liquid or convertible assets: cash, marketable securities, accounts receivable, inventory. We have 1, 2, 2, 3 here. Okay, now realize that this would have 3 zeros out at the bottom. So you would have to have 3 extra zeros, but what we have done is to truncate these. Okay, we have done away with the zeros, and you can add them at the end, but it just works better. Now on the PowerPoint slides, they do have them added in. Notice down at the bottom you have total assets. That would include your long-term, your fixed, which would be your big ticket items. So in the first ratio, you took your current assets and you divided that by your current liabilities. Those are the liabilities that we would pay off within the year, the first year. So that the first measure that we have is a measure of how quickly we can take our current assets and pay off those current liabilities. 1.97 to 1 is what that number represents, and basically that means that we can do it almost 2 times. Okay, we can pay off our current liabilities almost twice, and that's very good. Or it's $1.97 in current assets for every $1 in liabilities. So a measure of 2 to 1 is very good here. We looked at the current ratio benchmark. If you go to that, within the industry of computers as a whole, it was 2.5. However, the companies within that industry are a bit lower. Okay. Building materials, 2.8. So we're within the range. In fact, we're doing much better than some of the other companies would be. Okay, the next one was the quick ratio, meaning that we pulled out our inventory. Okay, inventory has to be sold, so it takes a bit longer. And so if you pull that out, it gives you a quicker measure of how quickly you can get cash. And in this case, it was 1.51 to 1. That's good. That's within the range that we would want. That would also mean that for every $1.51 in very quick assets, we have $1 in quick current liabilities. So that is definitely within the range. If you went back and you looked at your quick ratio analysis here, you can see that it falls within the range for computers. However, the building materials, they don't have as much inventory, so ours is a little bit high here. Again, we're making metal fasteners, so we really aren't in either one of these industries, and it's hard to compare, but I think we're in an acceptable range. Okay. Now, the next we want to look at would be your activity ratios, which we're doing today. So let's look at 5, 6, 7, and 8. 3, 4, 5, 6, 7, and 8. And then we want to look at our debt ratios, which would be 9 and 10. Number 11 through 15, which would be gross profit to return on asset, is your profitability. And then the last 3 would be your market ratios. And we'll get to those in class on Friday. Okay. Now, let's go to, I'm sorry, my computer shut down unexpectedly, so I had a little technical difficulty here. I'm trying to pull up all of this again. But let's take a look at number 3, our inventory turnover. We want our cost of goods sold divided by our inventory. So go to your income statement. Cost of goods sold here is 2088. This is the income statement, and we want to divide that in this case by our inventory. Now your inventory is going to come in on your balance sheet. So pull up your balance sheet, find your inventory. It's the fourth line down, 289, and those are the two numbers that you're going to use for this particular ratio. So 2088 divided by 289. Now, in the PowerPoints, remember that they have those with the 3 zeros on the end, but we have truncated or left them off. Now, if you run that through your calculator, you're going to come out with 7.2. 7.2. Now, that means that we sell our inventory 7.2 times during the period. Okay, we sell our inventory 7.2 times during the period. That's pretty good. Let's see if we have a benchmark for that. If you go to your benchmark sheet, inventory turnover, notice up here, if it's computer, it's 40 times. For Dell, 13.8. For Hewlett-Packard, 5.8 for the industry as a whole. If it's Home Depot and Lowe's, we're looking at 4.3 to 3.7, or 3.7 for the building material industry. Grocery stores sell theirs pretty quickly. Okay. Next row would be your Kroger and your Home Foods, and this is the grocery store industry, and the last is retail sales, Sears, and I can't remember the other store in this one, but merchandise sales. So some stores sell their inventory very fast. If you think of a grocery store, they have to get rid of their produce or it's going to spoil. However, if you think of some stores that, such as the building materials or large sale items, they're not going to sell theirs as quickly. So you could have issues there just because they're selling a big ticket item and they don't sell very quickly. Now Dell having 40 times, that's pretty good for a computer manufacturer. Maybe because they're small. I'm just not sure. But if you go back and you take a look at the PowerPoints, they do give you the ratios. Let me just show you on 312. They show you the ratios. They come back and they do show you with the 3 zeros on the number. We end up with the same answer, and then they give you a little explanation. They talk about a grocery store would sell their inventory quicker than an aircraft manufacturer because they have perishable items. Okay, let's come down to the next one. Now the next one has two parts. We have this one is going to be called average collection period, and it consists of our accounts receivable divided by our average sales per day. Now average sales per day is number 5, so we have to calculate number 5 before we can number 4. Now number 5 consists of annual sales divided by 365 days, and they use that to spread it out and make it longer rather than having 360 days. So let's find our income statement. I want to flip to our income statement here. We have a sales item amount of 3074. We want to use the most current number, 3074. And we want to divide by 365 days. Now when you calculate that number, you're going to come up with $8.42 per day. So we're selling $8.42 of merchandise per day. Okay. Now this ratio is used in the one before that we're actually trying to calculate. So put in here 8.42 as your denominator, and then let's go through and we want to find our accounts receivable. Okay, so let's go to our balance sheet, which is on the other page. Find accounts receivable, and the number you're looking for is 503 here. 503, okay? So let's plug that number in at this point, 503. Divide that by $8.42. And what you come up with is 59.7, and this one is days. Now, if you would, circle these answers that you're getting for these individual ratios, and they have different names. Notice how this one was times. This one we call 59.7 days, and that makes sense. You're looking at how quickly you're collecting your accounts receivable. So people out there owe you money. You want to find out how long does it take to get them to pay you. Okay, normally you allow 30 days for that. So if you're extending that collection period to almost 60 days, that's not good, because you should be getting your money quicker and you should be able to invest it or use it. So it depends on the time frame that you're actually allowing. Maybe some people have a 60-day collection period. Let's take a look at our benchmarks and see what they have here. Okay, so fourth column here, in the computer industry, 58 days, 80 days here for Hewlett-Packard, 61 days for the computer industry as a whole. Okay. If you're looking at Home Depot and Lowe's in the building supply industry, they don't generally extend credit, okay, like some companies would. They don't have their own credit lines, so it's very, very low here. Same way with grocery stores. You don't see grocery stores extending their own credit. Merchandisers, similar situation. Okay, so many times if you're looking at larger purchases like computers, you may have an opportunity to get credit extension through them and pay it off. It takes longer to pay it off, so that would be normal. However, the other industries, it's much lower. Okay. Now, the next one is average payment period. So in this one, we're looking at how long is it taking us to pay our accounts payable. In other words, when we purchase something from someone to resell perhaps, how long is it taking us to pay it? Okay. Now, again, this is one where you have to do the second part first. So let's do number 7 first. And I want to go to the PowerPoint slides. Okay, this is the ratio analysis for the one we previously did. And my computer keeps going out on me. But now on the next one, we want to look at this information. Average purchases here in this problem is 70% of cost of goods sold. So we have to go and look at what cost of goods sold is and then multiply that times 70%. Now you need to remember that cost of goods sold is going to be on your income statement. Okay, go to your income statement, second line under sales, 2088. Okay, that's your cost of goods sold. So come down here. Okay, 2088. And we want 70% of that. And this is because the problem specifies that. Okay, if you go to the PowerPoint slide 3-16, it tells you that. Then you want to divide that by 365 days, not 360, but 365. And when you run that through your calculator, you're going to come out with, carry it out as far as you can, $4, and it's almost 1 cent. But I just carried it out as far as I could. This means that what we purchase is about $4 and almost 1 cent per day. And remember, purchases would be for cost of goods sold items that we're going to use in either production or resale. Okay, now let's carry this number. This is one of your answers. So let's carry this number up to the number 6 that we're trying to calculate. So our average purchase is 4.004. And I would just leave everything as it is in the decimal form that it comes out in your calculator. Now you want to divide that into accounts payable. Now remember, accounts payable is a liability. So go to your balance sheet, go to your liability part where it says liability and equity, and you have 382 here. That's your accounts payable. This is going to be what we have borrowed for inventory. This is our IOU for inventory, and the other one is our IOU just for borrowing in general, not necessarily borrowing to resell. So when we owe a vendor for accounts payable, we have purchased something that we intend to resell or use in manufacturing. So 382 is the number you want to use here. Carry that back over. Put it in number 6, 382. Divide that by the number you calculated in 7. And what you have when you run that through your calculator, 95.4 days. So both of these are expressed in days, and then the denominator is per day. Now let me explain that. Normally vendors will give us 30 days to pay for our merchandise, just like we give other people 30 days. If we're taking 95 days and we can get by with that without paying interest, good for us, because many times they're going to charge you, just like a credit card would, interest if you go past the payment period. So if we're taking 90 something days to pay without paying interest, then we're using their money, okay? And that's, that's okay. But if we're having to pay interest on after 30 days, then we need to reevaluate what we're doing. Unfortunately, there's not a benchmark to compare this to, so I can't tell you what the industries are doing. But just realize this all depends. If this is good or bad depends on whether or not we're having to pay interest on that accounts payable like you would on a credit card if you go past 30 days. Okay. All right. Now that takes us down to one more in the liquidity. Total assets equals sales divided by total assets. So this is a turnover. When it says turnover, normally we're going to express it in terms of times. So let's find our sales figure. Our sales figure is going to be on our income statement. So find your income statement. Sales, 3074. And we want to divide that by total assets, which will come from your balance sheet. So let's write 3074 down so I can turn the page. And that is from your income statement. And then when I turn the page, we're going to get to total assets. Now I want you to see something. Remember, we're not looking at current assets. We're looking at total overall. So the bottom line here is 3597. 3597. So that's your denominator. When you run that through your calculator, it comes out as 0.85. Put times behind it. That's good. We're generating sales almost 0.85 times for every $1 of assets. You can also evaluate it like this by putting it 0.85 over 1. That means that for $1 of total assets, we're selling 85 cents of merchandise. Okay, 85 cents in sales for every $1 of total assets. So it can be looked at in that manner also. So this is a fairly, it's a decent turnover. Now let's take a look at what your benchmark would say. So coming to your benchmark, take a look. It does have total asset turnover. Depends on the industry. Some of them are much higher. Computer industry as a whole is around 0.9. Individual turnovers 1.6. Okay. Coming on down, some are higher than others, but I think 0.85 is fairly acceptable. This could be borderline computer industry range. Okay. All right, now we finished all of the activity ratios. Let's move on and do two more, which looks at how much debt a company has. So we want to look at the debt ratios. Okay. If you wanted to look at slide 20, it's on slide 20. I would go through and review all this with the PowerPoint slides and do the reading because they tell you a lot of interesting information. This arrow in the book is only if you're using the textbook, and we are not. So these are the next two ratios, and they're called the debt ratios. Okay, first one, let's find total liabilities. Now, a lot of students end up missing this one on the test, and I'll show you why. Let me show you why students end up missing this one on the test, and they really shouldn't. Let's find your balance sheet. Okay, both of these numbers are on your balance sheet. Now, total assets is fine. You know, it's labeled last number, and remember, assets equal liabilities plus owner's equity. But then what students do is they come down here and they pull out the same number from the very bottom of the liability and equity page, and they end up with a ratio of 1. And you can't do that, because what you have to do is you have to pull out all of the equity. Equity consists of all of your stock and your retained earnings. So this is your equity part, your stockholders' equity. You need to come up and look for total liabilities. If it's not listed, then add the liabilities starting with accounts payable and go all the way down through your long-term liabilities until stock begins. And this is a big mistake that students make when they're doing the test. So watch for that. Total liabilities is 1643 here. Total assets 3597. So let's plug that into your equation. And 1643. When you plug that in, it comes out to be 0.457. Okay, now let's just leave it in this form, or you could change it. This one is usually represented as a percentage. 2 decimal places to the right would change it to 45.7%. Now, this indicates how much is being borrowed, and Donald Trump is known for his leverage. This word leverage means debt or borrowing. Okay, and he's made a lot of money borrowing and used it to his advantage. However, back in the late 80s, early 90s, when we had some recession problems, that turned against him, and this can be a dangerous thing. Borrowing can be dangerous, per Dave Ramsey, if it's not used wisely. Okay, now you really want to limit your borrowing to 50%. So this is under 50%. That's okay. Once it starts getting over 50%, okay, you're getting in dangerous territory, and it can either make or break you, which it nearly, it did cause Donald Trump to go bankrupt on the Taj Mahal and some other things, but he nearly lost a lot during that time. Okay, so just remember that what this represents, if you leave it in decimal form, 0.457, it means that for every $1 of assets that you've borrowed, or you have, these are your assets, then you have borrowed about 46 cents. Okay, and you want to limit that to 50 cents on a dollar. Okay, now I hope that was pretty understandable. Now the other one tells you how many times you can pay your interest, okay, on your loans. So let's go to the next page, and our last one that we're going to look at is going to be your times interest earned. Let me just take you to your PowerPoint slide. Explains this on slide 22 under debt ratios. Let's see, times interest earned. Here we are right here. Okay. Now, here's a clarification. If you don't watch these slides, you're going to miss it. EBIT means earnings before interest and taxes. Another word for this, if it doesn't say that on your income statement, it's also called operating income or profit. And that's what it says on Bartlett. So you need to know that. And then you want to divide by your interest. So both of these numbers are found on your income statement. Let's go to your income statement. I have to keep switching back and forth here. Okay, your income statement. Come on down here. Let's find either earnings before interest and taxes or operating profits. Now, come on through. Here you go right here. Operating profits would be EBIT, because the next line you have is your interest. So it tells you what your interest is on the next line, which is going to be our denominator. So take 418 and divide by 93. Okay? So 418 divided by 93 is going to be, let's see what I've got here. 418 divided by 93 is going to be 4.5. Okay, 4.5, and I believe we expressed that one in terms of times. They don't really say, but I think this is a times situation. That means that we can pay our interest on our loans 4.5 times. Now, banks like that. The general measure should be between 3 to 5. Banks like to see that you have enough earnings to be able to pay the interest that's owed them. So both of those ratios are measures of debt. Okay, let's come back, see where we are on our slides, see what they have. Okay, the next slide will be profitability, so we'll get into that on Friday. Now, what you need to do for homework is to take your blank form. You should have 2 of these. Oops, sorry. Here's the other one. We've just done all these ratios. So you need a blank one. You need to make sure you're doing one for Apple and one for Bartlett. You need to do the ratios down through the first one on the second page, and you need to do those for Apple. And you need to work for 2013 using their balance sheet and their income statement. Now, there is some additional information you need to know because you're going to be asking me what interest is. So on the very last slide, slide 35, okay, it says interest is 5,080. Purchases are 70% of cost of goods sold, just like we calculated before. So 2 bits of information here. Interest 5,080 and purchases 70% of cost of goods sold, and that's going to be for your payment period, I believe. Okay? All right. Email with questions, and my husband is hopefully coming to class on Friday, and we'll finish up this lecture. Okay? Take care. Bye.